All right. The other thing is, what advice we give to young investors who almost certainly will have more direct responsibility for their retirement savings than their predecessors, of which I'm going to talk about later.
Well, I think the advantage of putting money into a retirement fund, obviously a Fidelity fund I would prefer, but index fund, whatever it is, put some money aside. It's going to compound tax-free.
Yeah.
Start saving earlier. The numbers are amazing.
Compounding will do wonders for you, won't it?
But until you want to invest directly in individual stocks, start a paper portfolio. Say, I'm going to buy these 10 companies, and then write down in like 5 bullets why. What's the reason I bought those? And then keep checking a year later, what happened? Did they really keep growing, or did a competitor come along? Do a paper portfolio, and you can do exactly what I did with a real portfolio and find out, what am I good at? What am I bad at? Am I really good at turnarounds? Am I good at small growth companies? Maybe I pay too high for stocks. You can do this you can do this over 4 or 5 years and learn what's your skills, and then specialize that. I had to own thousands of companies. You know, the average person, all you need is a few in your lifetime.
Yeah.
Make a difference.
When you were running $14 billion,
right?
Did you see in your mind's eye, and let's assume a lot of it was pension fund money and whatever, but did you see individuals, I'm investing for the fireman down the street? Yeah. Did you?
It was almost.
Or was it a game?
It was almost none of it was pension fund money. It was almost all individuals. People.
Right.
It was incredible, that thrill.
Yeah.
I got letters when the market went down to 87. My fund went down like a rock.
Yeah.
People were writing letters to me, cheering me up.
Oh, really?
Yeah. Oh, yeah. No complaints.
Mr. Lynch, you've done well for me.
Yeah, no, hang in there.
I know, hang in there, boy.
We'll be okay. You know. No, it's amazing.
Don't give up now, Peter.
No, it was. I meet these people all the time, at airports, all around. They're still. It was wonderful. It was the greatest thrill of my life. Our children and my wife managing money for other people.
Now we've also seen sort of today the whole business of hedge funds and private equity and shadow stuff. And now they're talking about getting into the mutual fund business. You think that's... Yeah. What do you think of that?
I mean,
hedge funds getting into mutual funds.
Well, a couple of differences, between a hedge fund and what I did in Magellan.
Right.
I could only buy long. I couldn't short.
So you couldn't sell short, right?
But I couldn't buy
hedge funds
commodities.
Can sell short, obviously.
Right. I couldn't buy commodities. I couldn't short the euro. I mean, they're into a lot, and they do it on leverage, a lot of leverage. So you have to be careful what you get into. There are some hedge funds that are very conservative. They're only going to be 20% short, mostly long. Because the nice thing about, occasionally, if you have an idea, if I found an idea that I thought was overpriced, I just went on to the next thing. I couldn't short it. So there is an advantage to be able to short, but I found that long only.
Well, but with these hedge funds who get into mutual funds, I mean, they'll have to also live up under the rules that mutual funds live under. Yeah, do you think they will be successful? I mean,
well, I found the long.
They're obviously tracking some.
The hedge funds that have been on the long side have done the best. I mean, they may have a little bit by being short, but being right on the long side. Because obviously, if you're right, you can make, and that's, I would say, when I ran Magellan, I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So that's, when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Wow.
and so when you look at the market today, it's a good time for
I think
investors to be there. I mean, obviously we're seeing new highs.
Right. I think the market is fairly priced on what's happening right now. You have to say to yourself, is 5 years from now, 10 years from now, corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. Yeah. So I think that's the kind of numbers you're interested. That's better. A 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
It bothers me that people are very dangerous when they invest. This word, play the market, that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator, careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or at a party. That's dangerous.
So when you say buy what you know, you also thought that the regular investor might be able to get an inside advantage by sticking to an industry he's familiar with or seeing something that she realizes is a great product.
Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot. You would have seen Limited when it was hot. You would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. Or then you do some research, say, well, gee, there's a lot of limited stores, but we're only at 20. You know, they can go to 400. So you see a company. I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that this is really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. So but you don't leave the mall, though, and buy that day. You have to do some more work.
That's the important point.
Yeah.
So today, there's so much information everywhere, information overload. Does that make it harder for active investors? The indexers say everyone's got access to the same information at the same time. You can't beat the market.
Well, the way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny, and where the companies are deteriorated. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in.
Now, a lot of people, when they're lucky enough or smart enough to get a company that's going up, they take their profits. Right. And you made the case in a book that you should actually hang in there with the really great stocks, and you even got a call from Warren Buffett as a result.
Yeah, in 1989, I'm at home, and the phone rings, and I thought it was one of my friends, but one of my daughters, I think it was 6-year-old Annie, picked up and said, gee, guess there's a Mr. Buffett on the line? I said, this has got to be a joke. So I pick it up, and this Warren Buffett, I'm from Omaha, Nebraska. You know, I read your book. My annual report's due in 2 weeks. Can I use the line? He said that all in about 7 seconds. And I said, that's great. I'd love to do it. What's the line? He said, I love this. It's been waiting to do this. When you sell your great companies and add to the losers, it's like watering the weeds and cutting the flowers. And he said, I want to put it in. He said, if you ever come to Nebraska, you don't call me, your name will be mud all over Nebraska.
So did he call him?
Oh, yeah. Several times we played bridge together. We've had several meetings. Great guy.
Another point you've made, and this is, I think, particularly relevant 10 years into a bull market, is that I think you said more money has been lost anticipating a downturn than actually in the downturn. Can you explain?
Well, obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Whenever the market went down, I went down more. But over the long term, the upside is more than the downside. So you got to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.